Welcome to The Explainer. Today, we're diving into a really big change happening in Papua New Guinea's financial world, a totally new Income Tax Act.
Yeah, we're talking about a law that's going to impact pretty much everyone who lives and works in Papua New Guinea. This is the new Income Tax Act 2025, and trust me, you're going to want to understand it. All right, so first, let's just set the stage for this massive overhaul so we can get a sense of just how significant this change really is.
Look, this is not just some minor update. We are talking about replacing a law that has been the very bedrock of PNG's tax system since 1959. Can you believe that? That's over 65 years of history getting a complete rewrite. This new act, passed in 2025, is all about bringing the system into the modern age, and it all officially kicks off on January 1st, 2026.
So, to really get a grip on this new law, we've got to start with the absolute basics, the key definitions. You know, how the Act defines words like business or resident pretty much dictates everything that follows. So first up is the word business. And wow, is this definition broad? I mean, you need to think way beyond just a typical office or a shop. This definition is designed to cover just about everything, from a huge corporation all the way down to a freelance consultant, as long as the main goal is to make a profit.
This next concept, permanent establishment, is absolutely crucial. Think of it like a legal tripwire. It's the threshold that determines when a foreign business's activity in PNG becomes significant enough that it has to be taxed there. It could be a physical place, sure, but it could even be a service contract that lasts for more than half the year.
Now we're getting to one of the most important ideas in the entire Act, the difference between being a resident and a non-resident. I'm not kidding, this single distinction fundamentally changes how you get taxed. For residents, the government can look at your worldwide income, but for non-residents, they're typically just focused on the income you make inside PNG.
So for you, as an individual, your residency isn't just about what passport you carry. The key test, and the one that matters for a lot of people, is physical presence. If you spend more than half the year, that's 183 days, in Papua New Guinea, you are generally going to be considered a resident for tax purposes. You can imagine this has massive implications for the large expatriate workforce in the country.
And you know what? It's a similar logic for companies. It's about where they're legally set up, sure, but more importantly, it's about where the big decisions are actually being made. If the brain of the company is in PNG, it's a resident company no matter where else its operations are.
Okay, so we've established who can be taxed. The next logical question has to be, well, what income gets taxed? And this brings us right to the concept of PNG source income. And the great thing is, this isn't left up to interpretation or guesswork. The law gives us a really clear, pretty extensive list that answers this exact question. And we're going to look at that right now.
The main idea here is pretty simple. It's all about where the value is generated. So, if you're physically working in PNG, your salary is considered PNG source income, even if your company pays you from an overseas account. And that same logic applies right across the board, to profits from a local business, dividends from a PNG company, or gains you make from selling property that's located in the country.
And hey, just to give you a little perspective here, we are simplifying dozens and dozens of pages of some really dense legal text to give you the high-level, practical view of what you actually need to know.
Okay, so now that we know what kind of income is taxable, let's have a look at the different ways, the different mechanisms the Act uses to collect that revenue.
This is the one that most people are probably familiar with. It's the salary and wages tax. It's simply the tax that's deducted directly from your pay every 2 weeks if you're employed for work you're doing in PNG.
To try and make things a bit simpler for smaller entrepreneurs, the Act also includes a specific, optional tax system for sole traders. The only catch is their annual turnover can't go above a certain limit.
All right, this next one is a huge new piece of the tax system. It's the capital gains tax. What this means is that if you sell certain assets, like say real estate or shares, for more than you paid for them, that profit, that capital gain, is now going to be taxable. This is a big deal. Next up is the non-resident tax, which is basically a type of withholding tax. All that means is that the tax is collected right at the source. So, when a company in PNG pays dividends to an investor overseas, the tax gets taken out before the money ever leaves the country.
The Act also gets very specific about big global industries. For example, for shipping and airline companies, it taxes the income they make from any journey carrying passengers or goods that begins in Papua New Guinea.
Okay, so after all that detail, what are the absolutely crucial points that you need to remember from all this? Let's just boil it all down.
Seriously, if you remember nothing else, just remember these 4 points. First, a completely new era of tax law is starting on January 1st, 2026. Second, your residency status is key. It is the single most important factor. Third, the definition of what counts as local PNG income is very broad. And fourth, you need to be aware of new taxes, especially that big one, capital gains tax.
This is not just a minor update. It's a fundamental shift in the entire financial landscape of Papua New Guinea. Understanding these changes right now is the very first and most important step to making sure you're prepared for what's coming.